Hello everyone and welcome to my YouTube channel where I teach economics for students of class 11th and 12th, and this is going to be a continuation of the chapter National Income and Related Aggregates, which is a part of the series Introductory Macroeconomics. Just a quick recap of the videos which I've already uploaded in my channel. In the first video you can check out the basic terms of national income. In the second video you can understand about the concept of circular flow of income. In the third video, I explained about the basics of national income, and in this video, we will begin to understand about value-added method of measuring national income. So once again, a quick recap of what is national income. In very simple terms, it is the total income earned by the residents of a country, even in a given year. But then how do these residents earn this income? They earn this by producing goods and services. So we can also make this definition a bit better by clarifying and telling that the sum total of the value of goods and services produced in an economy in a given year is called as national income. Very easy to understand, and that was already explained in the previous video. So now let us see the three methods used to calculate national income all around the world. We have the first method, that is the value added or product method. The second one is the expenditure method, and the third one is the income method. So in this particular series, I will be teaching you all the three methods along with numerical explanations and numerical problems so that it will be very, very comprehensive for you to understand. So without wasting much time, let's begin the first method, that is the value added or product method. The clue to understand this particular method is in the name itself. Now this value added or product method is based on measuring the contribution of producers in an economy in a year. Any person who creates from raw materials a finished product is called as a producer, and this producer sells this finished product. So another term for producer is seller. So in this method, we are going to calculate or add up all the contributions done by all sellers or producers in an economy. Now, as we know, a seller or a producer can produce consumer goods, which are for consumption, or a producer can produce capital goods, which are used to create further goods. So in this method, we are going to calculate the value of all consumer goods and capital goods. So in simple terms, value added by the producer or the product or the value of the product produced by the producer in the economy is added, and the entire value added or the entire product will be understood as national income. So in this particular method of calculating national income, we will not consider all those items which do not have any money value. For example, a mother works at home, but then nobody pays her salary or remuneration, and that work cannot be compared with money. So that will not be included in national income. Or any free repairs, if at all we go to a mechanic and that mechanic provides us free repairs, those free repairs or free services will not be included in this method, simply for the fact because there is no value added or there is no product produced. So in this method, anything free is not measured, only those things which have value will be measured. To give more clarity, let me try to explain this concept with the help of an example. We have a farmer and a baker in an economy. Now, a farmer produces wheat, and the farmer's wheat is used by the baker to produce bread. Let's assume that a farmer creates or produces wheat worth rupees 100. And out of it, he sells 50 rupees worth of wheat to the baker. The baker uses this 50 rupees worth of wheat, and from that he creates bread which is now worth rupees 200. So in simple terms, in this particular example, we should try to understand what is the value added by the farmer to the economy and what is the value added by the baker to the economy. To have a proper understanding, we should understand with the formula value of goods and services minus value of intermediate goods is equal to gross value added. In simple terms, the value created by either the farmer or baker has to be reduced with the use of intermediate goods. And in the basic terms video, I already explained that intermediate goods is nothing but the raw materials used. To give more clarity, here is the table. The farmer has added 100 rupees worth of value to the economy, and so the total value added by the farmer will be rupees 100. The baker used 50 rupees of raw materials from the farmer, and so that is already included in the value added by the farmer. So the baker has created bread worth rupees 200 but used 50 rupees worth of value of the farmer. So actually 200, that is the value of goods and services created by the baker, minus 50, value of intermediate goods or raw materials, is equal to 150, that is the gross value added by the baker. And when you add the value of the farmer with the value of the baker, 100 plus 150, you get 250, which is the gross value added by both farmer and baker. I hope you understood with this simple and clear example. The process still goes further. Now, as I told you, in the value added method, we add the value or the product of consumer goods as well as capital goods. But in order to understand the real value of capital goods, we should take into consideration a concept called as wear and tear or obsolescence. Wear and tear is nothing but the constant use of an asset which results in the degradation of its value. Or obsolescence means when a particular asset or a goods gets outdated. And so since these capital goods are constantly being used, we have to reduce their value. So the reduction in value should also be considered, and this reduction in value is termed as depreciation or capital consumption. This also has been explained in the basic terms. Now by reducing depreciation, we get the actual value. Let's see what am I talking about with the help of an example. A producer has produced 100 rupees worth goods from raw materials worth rupees 20. But then his machine depreciated by rupees 10. So what is the actual value which he has added to the economy? It is 100 rupees minus the raw materials, so which means the value is 80, and minus depreciation, which means the net value added is rupees 70. So in order to simplify whatever we have been discussing till now, we have this small formula here. Value of goods and services, in the above example it's 100 rupees, minus intermediate goods, that is 20, will become gross value added, that is 80 rupees. And from this gross value added, when we reduce depreciation or capital consumption, that is 10 rupees in the above example, we get the net value added, that is 70 rupees. Moving further, we will now move into the further process of understanding the value added method. There is another concept called as inventory, or in simple terms, stock. Now everything produced by the producer might be sold in the same year, but that's just a possibility. There is also an equal possibility that some things might not be sold. So the remaining unsold stock is termed as inventory. Whenever we are calculating inventory, we should remember that sometimes unsold stock of the previous year will be carried forward to the next year. But we should remember that that was the value created in the previous year. So the value created in the last year should not be added in the current year. And that value of unsold stock of last year is called as opening stock. Now the value created in the current year but unsold must be added in the gross value, and that value of unsold stock of this year is called as closing stock. So in simple terms, what is change in inventory? Change in inventory is nothing but the production in the current year minus sales. So whatever you have produced in this current year minus whatever you have sold, if at all there is something remaining, that will be the change in stock or change in inventory. And since you have added a value to the economy in this year, that definitely has to be included while calculating national income using value added method. Now, to complicate things, we have planned and unplanned inventory. I have tried to use an example so that it will be very, very easy for you to understand. Now, imagine a person has 100 pens which were unsold last year. So that is the opening stock. And that same producer plans of selling 1000 pens. And so, since he has planned 1000 pens, he produced 1000 pens. Sadly, in that year, the person was able to sell only 600 pens. So, he had 100 pens as opening stock. He created 1000 more pens, which means he has now 1100 pens. And from that, he sold 600 pens, which means with at the end of the year, he has 500 pens remaining. And that is called as unplanned accumulation of inventory, which means he planned selling 1000, but he was able to sell only 600. And because of that, the value of inventory has increased unplanned. That is unplanned accumulation of inventory. Continuing further, the same example, he has 100 pens as opening stock and he plans of selling 800. He produced 1000 pens and he sold 800. So he had 100 pens as opening stock, produced 1000 pens, which means he has 1100 pens. He has planned selling 800, which means he wants 300 pens remaining unsold, and things go according to that person's plan. So with that, he definitely sells 800 pens and 300 pens remain. That is called as planned accumulation of inventory or increase in inventory as per the plan. Let's continue. 100 pens as opening stock and the person plans of selling 1000 pens. And he produces 1000 pens, which means now he has 1100 pens. But he sold more than what he planned, that is 1080 pens, which means he had 1100 pens with him. He sold 1080 pens and he has only 20 pens remaining with him. This is called as unplanned decumulation of inventory or reduction in inventory since the plan was not followed. And the final example, once again 100 pens as opening stock and the person plans of selling 1100 pens. So he produces 1000 pens thinking that he is going to sell the entire stock of 1100. And definitely things go according to that person's plan. He sold 1100 pens and there are no pens remaining with him. This is called as planned decumulation of inventory or reduction in the value of stock as per the plan. So a quick summary of whatever we have been discussing till now. To understand the entire video, I have tried to prepare it in one simple formula. So intermediate goods are symbolized by the letter Z and change in inventory is symbolized by the letter A. So we have total sales plus change in inventory, that is A, minus intermediate goods Z will become gross value added. When this gross value added is reduced with depreciation, it becomes net value added. Now the gross value added of all the firms working in all the three sectors, that is the primary sector, secondary sector and tertiary sector, becomes the GDP of an economy. And from this GDP, when we reduce depreciation, it becomes the NDP of an economy. So the question now arises, what is GDP and what is this NDP? It's very easy. GDP is gross domestic product, and it is the total value of goods and services created within the boundaries of a country, which means any value added by creation of goods and services within the boundaries of a country, either by your own citizens or even foreign nationals working within the boundaries of your country, everything will be included in GDP. As I've explained there, it includes all income earned by residents, domestic or foreign. Now, you might be having the question, what about our relatives who are working abroad? Income earned by citizens working in abroad In and abroad the economy will be called as gross national product. Okay, so citizens who are working inside the country and outside the country, only our citizens' income will be called as gross national product. We will be dealing with that in the next videos. A small fun fact, an embassy, usually where you get your visa, is a place where a foreign nation manages its affairs in a domestic country. For example, if France has their embassy in Mumbai called as the French embassy, the compound of the French embassy will not be considered as Indian territory, it will be considered as French territory. In the same way, if India has an embassy in Marseille, France, that Indian compound will not be considered as French territory, it will be considered as Indian territory. Okay, and with that we come to the end of this video. Just a quick recap of whatever we have been discussing, and it's all available in my YouTube channel. The first video was about basic terms, the second video was about the circular flow of income, the third video was about the basics of national income, and in this video I have explained or introduced you to value added method. In the next video we will have more explanation on the value added method. Thank you so much for staying tuned till now. If you found this video helpful, please like, share and subscribe so that many more students can benefit from it. Thank you so much. Stay educated and stay safe.